Hey everybody, it is good to be here. My name is Brent Moores. We do this each Friday at this time, condors, calendars, and butterflies, and we try and mix it up a little bit. Although we are going to do calendars today, and it's going to be kind of a continuation of our discussion of last week. If you haven't seen that, I encourage you to go back and check out last week's session. You can see other sessions that we've done in this webcast as well. I'll put the playlist in the chat here, and I'll also show you at the end um, where to find playlists, stuff like that. But if you're watching live, there's a playlist for you. Hey, I'm joined by James Boyd in the chat. Appreciate James helping me out. So as you have questions, between James and myself, we'll do our best to get your questions answered. Also, you can follow us on X at Brent Moores CS, at James Boyd CS, and James teaches multiple classes throughout the week, including Friday mornings. He teaches an ETF webcast at 9:30 Eastern Time. Make sure you check that one out. He teaches that alongside Kevin Horner. Now, before we get too far into this, let me just mention a few important bits of information. One, options do carry a high level of risk and are not suitable for all investors. And the material today is intended for general informational purposes only and educational purposes. It's not an individual recommendation. We'll look at individual stocks today, but those aren't recommendations. Those are examples. And that's what we try and do in this class, is give you examples and empower you to do it on your own. Remember, as we look at the thinkorswim desktop software, that it does not assign short options early, but that's different than real life, where short options can be assigned at any time up to expiration, regardless of the in-the-money amount. The paper money application is for educational purposes only. And let's see, all investing involves risk, including loss of principal. Past performance is no guarantee of future results. Schwab does not recommend the use of technical analysis as the sole means of investment research. I won't be factoring in commissions or fees, but just realize those are probably an important consideration for you to think about as you're doing this. And there's no guarantee of an execution at or near the stop price. This is the market. We're up again. And so, that's what it is. A lot of it's just kind of what's going to happen with the war news, conflict news, oil. Here's oil prices. We're not going to talk about trading oil, but here's oil prices down a little bit today. It's just, you're kind of like reading between the lines. Investors are, at least. The market is, as to what the progress is going to happen, what the future prospects are with the conflict with Iran. So that's what we're seeing right there. But let's go back here and just talk about calendar spreads, because we talked about calendar spreads last week. And last week when we did these, I kind of gave you a general introduction to calendar spreads to try and illustrate how they work. And we said often what we'll do is we'll sell a call or put, okay? So a calendar spread is, it's supposed to be an E there, I kind of mangled that. But we're going to sell out, roughly 30 days out, and we'll buy a contract, the same type, same strike, maybe an extra month beyond that, maybe 60 days out or something like that. And those are just kind of rough estimates. And that the whole point of calendar spreads is we're trying to take advantage of that time decay in that first contract. And one of the things I said, though, was one of the challenges with calendar spreads is it can be hard to find higher probability calendar spreads when we do them like that. Higher probability trades. And there's different things we can do. We can do double calendars, that is, do the call calendar and the put calendar at the same time. I think I gave you an example of that last week. You can diagonalize the calendar a little bit and make it directional. That's another way to do it. But we're not bound by these rules here. These weren't strict rules. That's just kind of a traditional way of people looking at calendar spreads. But what I'm going to do is I'm going to move the time frame up pretty significantly this week, and I'm going to take advantage of our earnings calendar because we're in earnings season, folks. Here's the earnings calendar for the S&P 100, and today is the 24th, and I just kind of have them listed here. And you can see next week, what do we have in earnings next week? Well, we can see some big names here. General Motors, Coke, UPS, Booking, Mondelez, Starbucks. And as we go to this, some even bigger ones. Amazon, Mag 7 type stocks. Amazon, Alphabet, Meta, Microsoft, Qualcomm. Those are all next week. So next week is like crazy earnings week here. We're in earnings season, and usually about the third week of earnings season is when you start to get the big hitters here, so to speak, and that's what they are. And they can certainly push the market there. But if we're going to do a calendar spread on earnings, the one question that you may have is, well, look, calendar spreads are generally what we'd call positive vega trades. That means they tend to benefit if implied volatilities go up. Well, when earnings comes out, implied volatilities tend to drop. Okay, I probably don't need to. I think a lot of you have seen this. If I just pull up a chart of, I don't know, Microsoft, here's Microsoft, and I were to look at the implied volatility on Microsoft, what you're going to see is typically when earnings comes out, here's earnings upcoming, IVs drop. IVs drop, and I would expect, no guarantees, IVs will likely drop there. So it may not make sense to do calendar spreads before earnings, but there's another factor in here that I want to mention, and we're going to look at that. And so for that, let's take a look at a specific example. Here's Alphabet. I have Alphabet up here, and let me just go back to my normal chart. And if you look at the option chain on Alphabet, what you're going to see is, here's your implied volatilities on the right. Okay, so for those of you who are newer, implied volatility just measures how much the market is pricing in an expected move. Bigger, higher implied volatilities expect a bigger move. They're also more expensive options. But what you notice is before earnings, okay, and on Google or Alphabet, we have earnings on the 29th. So this and these two expirations right here would come before earnings. So they're not going to be affected by the volatility of earnings. So they're lower implied volatilities. And then we have this kind of spike of implied volatility after earnings. But notice that as you look further forward in time, the IVs go down. And so if you sell one of these contracts and buy one of these later contracts, yes, implied volatilities may go down on everything, but they're probably going to go down a lot more on the ones you sell. And with the calendar spread, even though we say it's a positive vega trade, the reality is it's made up of two components. One is a negative vega component, which benefits from a drop in implied volatility, and a positive vega component, which gets hurt by a drop of implied volatility. But you're probably going to see a bigger effect on this one than this one, because that implied volatility has farther to go down. Okay, I'm hoping that's making sense. So there we go. That's kind of the rationale of doing these through earnings. Well, let's take a look at them. Okay, let's just take a look at an example. And for this example, what I'm going to do is I'm going to go to we'll go to the Analyze tab. We'll go to Add Simulated Trades. Here's Alphabet. And I'm going to go just past earnings here. May 1st gets us past earnings because we said earnings is on the 29th. April 27th doesn't get us past earnings. George says FOMC meeting next week too. Yeah, and whatever they say, even though the odds are that there's probably not going to be like any sort of like rate cut indication anytime in the near future. The market's betting against, the market seems to believe that. What comes out of the Fed speakers' mouths can certainly affect the market. So there's your implied volatility. That can affect implied volatility. But I'm going to go to the first one past earnings, and I'm going to go to May 1st. Okay. And our stock right now is around 344. Let's just look at our chart. Here's Google. So we're kind of bumping up to almost near these all-time, well, yeah, that's all-time highs, I think, on Alphabet up there. Okay. So that's kind of the potential resistance there maybe, but this is kind of the range we're in. And if I'm willing to say, I'm going to go kind of neutral on this, I'm going to go, we'll just say that, do we have $5 strike increments? $2.50 strike increments. So I could either go to, if I want to be like right at the money, this is kind of halfway in between the 342, let me just look, 342.50 and the 345, and doesn't really matter. Let me go to the 342.50 and I'm going to sell that. Let's go down, and I'm just going to go down to, we'll give it a couple weeks here. Oh, no, notice, by the way, as we look at this, there's a lot of strikes. This is kind of a newer thing out there. But go back 6 months, we didn't have strikes. We didn't have expirations, you know, all the time on these individual stocks. You'd see this on index options, okay? But on some of these like Mag 7 type stocks, and there's a few others, you end up with a lot of expirations. But we sold that one. I'm going to go out to, we'll go out to the monthly contracts, May 15th, okay? So I'm going to go to May 15th, and I already forgot what strike I chose. What did I do? One sec. We said 342.50, okay? So I'm going to go out here, 342.50. I'm going to do a put, and I'm going to buy this one, okay? There we go. And then let's look at our risk profile. Here's our risk profile on this. So, and then as we look at this risk profile, this is going to be today's date down here in the bottom right. Up here, we're going to go 1 day past our first expiration. So I'm going to go to May 2nd on that. And then we can look at the trade. I'm going to set my slices to break even. And we can look at this. And this looks very different than what we saw last week, right? We're looking at 67% between our break evens on this one. So this is what we'd consider to be a higher probability trade. Last week I said, you know, doing it the way we were kind of doing it before, it's a little bit harder to get those higher probability trades. Squeezing these together, it's not as high it's a higher probability trade. A little bit more dependent on price movement, a little less on just the time. There's just not that many days of time decay to help you out, and we really aren't going to have a chance to roll it either in that case. So as we look at this and we're considering this trade, just remember, we've got two contracts. We've got this put short, this put long, and our implied volatility is going to affect these a little bit differently there. And that should only kind of help the trade. Now we have earnings, so there's more likelihood of a bigger move in Alphabet. So let's look at Alphabet and let's just kind of look and just see, you know, this is looking at like a $20 move on earnings. So when we're looking at this, I mean, where's a $20 move put us on this? From 343 to 363, that's, you know, there, and 343 down to 323 there. This is kind of the range that the market is having us expecting in terms of the movement there of that. So that's one of the things. You don't have to avoid earnings, but some people do just because of the the expected movement there on that stock. But it puts us about in line with these numbers, these break evens. We said, I think it was like 363, 323 or something like that. So these, if you have a hard time reading that, that's 324 break even, 365 break even. So that's the range there, the 67% range here on that. So in terms of managing these, normally what we'll do is we'll look at these from this standpoint and we'll look to exit after earnings before the first expiration. We don't let this go to the first expiration. When I was talking to you about calendars last week, I said, well, with about 10 days to go to expiration, we're going to look to get out, or a week to go to expiration, we're going to get out. Obviously, that can't happen here in this case. So how do you do the trade? Well, if you're on the trade tab, you can go here and you can go spread calendar right there. And it's going to give you a whole bunch of dates. And I don't just pick the one. We were doing May 1st, 15th. Well, it doesn't give me May 1st and 15th. I can play around with if I want and go deep and wide and go different expiration dates. But to be honest, here's what I do. I just pick the first date, May 1st, 15th. I do my strike price, 342.50. We're buying that, and then I just tweak this to May 15th. Easy enough, okay? And so there's the trade right there. And probably move it off this just a little bit. And I'm going to click on confirm and send. And I'm going to put this in the, I don't have my groups out there right now there. Okay. So let's talk about managing here just a little bit. Let's say earnings comes about. Let me send this. Okay, I just sent that filled. Once earnings comes about, you're going to have a short leg and a long leg. So if I look at my monitor tab and I look at Alphabet, I've got a short leg and a long leg. So once earnings comes about, obviously this will not be 7 and 21 anymore. It'll be like, I don't know, 3 or 2 and whatever, 16 or something like that. We're going to look to get out. Now, you can get them out of them both at once if you want. You can get out one at a time. Typically, if we're going to get out one at a time, as George mentioned in the chat, usually we'll close out the short one first there. Now, could you get out of the short one and just stay with the long one? You can. At that point, we're just turning it into a plain old long put trade if we were to do that. And so that's just a purely bearish play. And if that's what you want, if you're looking at Alphabet and saying, hey, this is a perfect opportunity for a long put, then maybe you do that. Otherwise, you're probably going to look to get out of both of those trades there. Okay? So there we go. That's straight. Let's look at some other examples here. Okay? Let's do another. I'm going to do earnings. I'm going to focus on earnings here on this. Let me do another one, and then we'll maybe do a couple more actually. Let me go to that. Let me do this. I'm going to do Meta. So let's look at Meta. And I'll go to the Analyze tab on Meta. I'm going to look at the chart on Meta. Again, we have earnings coming out on the 29th, I think. I guess the 29th there, yeah, 29th. And I'm going to go basically at the money. Now, you can skew this a little more bullish or a little more bearish, of course. If you're more bullish, remember, whatever strike price you pick is where you want the stock to go. I mean, this is more of a neutral trade is how we characterize it. But if I pick 725 strikes, then I've just turned this into a bullish trade. Okay. Let me clear out of that. But in this case, we're right about 675. Let me just jot that down, 675. And I'm just going to stay about 675 on that. But you can skew it a little more bullish or bearish if you want. So let's go to the Analyze tab. And I'm going to do, again, I'm going to go past earnings on this. We'll go to May 1st. May 1st is just past earnings. And we said 675, which is right at the money. And I'm just going to sell right at the money. And then I'm going to go out, and I don't need to go. Last one we went 2 weeks out. We can just go 1 week away from that. So there's only a 1 week gap between those. 675, I'm going to click on the ask price and click on our risk profile. Now we can tweak this if we want, but let me just make sure I got this right. This should be May 2nd up here. May 2nd. We're going to set our slices to break even. Everything I said about implied volatilities on Alphabet apply to implied volatilities here, because if you look at Meta, let me go back to single. If you look at Meta, what we're going to see is you get a diminution, you get a drop in those IVs as you go out further in time. There's about, from 68 to 54, about a 14% difference in IVs for the months there, for the expirations there. It doesn't mean that the gap's going to close 100%, but it typically will significantly narrow there in those. So there's, so that's the trade. That's a trade. So you don't need to spread it out. I did 2 weeks before. We could go 1 week on that, and you can paper trade that if you like. Remember, through earnings, our earnings date is April 29th. So April 30th, maybe something, you're probably going to be looking to, well, let's see, what day of the week is, that's probably Friday. So April, I don't know what day of the week that is. This is going to be a Friday, so it's probably early in the week. So probably April 30th, day after expiration, maybe you'll look to get out of that trade. All right, let's go forward. So the first one is going to be right after expiration, typically. But sometimes you'll tweak things a little bit depending on liquidity. Now, I just looked at Alphabet and Meta, which are very liquid companies with liquid options. So you probably can pick almost any expiration date, and there may be something there. Just double check. But on some stocks, you may have some more issues on that. Let's take another example. Let me go to, oh, by the way, that's good enough. Let's go to Starbucks here. Okay, so I'm going to go to Starbucks, SBUX. That was on the list, by the way, of earnings. Earnings on this is April 28th. Let me just jot that down real quick so I don't forget. April 28th. Stock right now is around 99. And if you think the stock is going to be, well, what do you think? You know, if you're bullish on this, then we may pick strikes higher. If we think, hey, this seems like a pretty reasonable range kind of in here, then maybe we pick something, I don't know, around 97 or something like that. And do that. So let's go and look at our choices here. Now our options are going to be a little less liquid on this, so we'll just have to see. I can go to the Analyze tab. I can go to Add Simulated Trades. I'm going to go to the first one past expiration. We said expiration was the 28th, so I'm going to go to May 1st. I was going to do the 97. Now, I'm going to go to the puts here. Do I do calls or puts? Here's puts on the right. Here's calls on the left. Generally, we're going to keep them out of the money. So If your stock price, which right now is around 99, is above the strike price we're choosing, we're probably going to do puts, a put calendar. If the strike price is below the, above the strike that we're choosing, the stock price, then we'll probably do a call there in that. But in this case, our strike price is below the current stock price, so I'm going to look at puts here on this. So let me go here. I'm just going to do May 7th. We're going to do 97. I'm going to sell that. And then I'm going to go out and let's look out a week here. And I mean, here's your open interest. Here's your volume. Okay. I'm not so concerned about volume. In fact, I'm not concerned at all about volume, but I am concerned about open interest. That is a lower number on that. Our bid-ask spread is about 40 cents roughly, which is kind of on the high end of things. Sometimes if you go to the monthly contracts, hopefully this works out, our open interest is a little bit higher, not spectacularly high by any means, but we have about a 25-cent bid-ask spread on a 350 option. So this is spreading out 2 weeks instead of the 1 week. We can still click on buy. We can still then look at this trade, and we can go to our risk profile. Let me just make sure I don't have any extraneous trades there. I don't. By the way, when you're using the risk profile tool and you pull it up, and I say this pretty much every week, but I think it bears repeating, double check that you don't have extra trades down here or, simulated trades or actual trades here. If you do, if you have an actual trade down here, say we already had a trade on Starbucks, which we don't, you can just uncheck it there, and then you can just view your simulated trade that you want to look at right at the top of the page. You can do the same thing on simulations, or if you want to get rid of them, you can just X out the simulation. You can't just X out if it's a real trade there, though. So let me go back here and let's just look at this. Again, I'm doing May 2nd because all these have expiration next week here. If you're doing this 2 weeks out, that's no problem. Just pick the strike, pick the expiration date that's immediately past your expiration. Let's set our slices. Break even. Again, higher probability trade. This is very different than the calendar spreads that we were looking at last week here. But we kind of, these are earnings trades. You don't have to avoid earnings, but there's just more volatility that's going to come out with earnings. When I say volatility, more stock volatility, but also implied volatilities on options. And so they should, in theory, they should compensate for each other. Okay? That's true, by the way, going out of calendar mode for a sec. If you're just buying an option, okay? Let's say you're buying a call. And ideally, what you'd want is to buy it for as cheap as possible, okay? But then you want the stock to move as much as possible. But the reality is, when people expect bigger movements going forward, implied volatilities are going to be higher. Now, of course, there's unexpected movements that we may have that's not priced into IVs, but IVs are just based on what expectations are. So do you buy calls in a high IV environment? Most people say, no, not really, because that means we're spending a lot more money on them. But in theory, it's a high IV for a reason. It's a high IV because we think the stock is going to move more. Now, you may say, well, it could move up or down more. But keep in mind, there's an asymmetric risk on these things when you're looking at a long call or a long put for that matter. But this is what I mean by that. I'm going to see if I can show you. We'll just show you on this individual trade here. Let's do, we're talking about a put. Let me just do a long put. I'm just going to uncheck this. What I mean by asymmetric risk is there, yes, the stock could move your way or the opposite way significantly, but if it moves against us significantly, we're limiting our risk right there. Now, it still may be substantial, but if it moves our way, the way we want it to, in this case it's a put, there's more potential gain than we have loss on that. So that's why you want big movement out of options, expectations out of options. But my broader point is implied volatility kinds of makes up for it. If you're paying more for a call or put, a long call or long put, because of higher implied volatilities, the expectation is a bigger move for you. Similarly, if you're shorting a call or shorting a put, ideally you'd want higher implied volatilities because then you can sell it for more. But why are implied volatilities high? Because people expect a bigger movement, which works against you if you're in the case of a short option. Let's go to our short option here. Let's just look at our short option. Again, we have this asymmetric risk thing coming up. In the case of a short option, it can move for us, this way in this case, or against us. But if it goes for us, in the case of just a single short put here, well, we have pretty limited gains here on this. If it moves against us, there's significant losses. So options often have this kind of asymmetric risk scenario on those. Not always, but just long calls, long puts, short calls, short puts do. When you make something like a calendar spread, that's not really the case. It can go way up. Well, we're limited here, but way down, we're limited as well. The risk on a calendar spread is going to be your initial debit. So whatever the cost of that calendar spread is going to be. So in this case, that's the difference between these, which is roughly $1.20, $1.16, I think, $1.16 there. So anyway, let's do that trade. The rules are going to be the same. This is one where you can tweak these. You can tweak the strikes, play around with it, tweak the expiration months. That's one of the nice things about these trades. Look, I can go here and we can compare it. Let's go to May 22nd. And we can then set our slices, break even, and see. It doesn't change it much. My concern on the May 22nd one would be going back to our prior concern, which was bid-ask spread on the 97 strike. You see, it's not bad at all. We could certainly even do that one if we wanted to. All right. So let's add that trade in here as well. Just as a reminder, if you want, you can change spread to calendar, or you can leave it on single, and you can go to the individual contracts and just click on them one at a time. We're doing the 97 put. We're selling the front month. We're going to May 15th. We're going to buy the back. I'm going to hold down my control key, because if I don't hold down the control key, it will replace the first one trade with the second trade. I don't want to replace it. I want to add on to it. Okay. John Smith said, what's the potential profit on a calendar? That's why we're using the Analyze tab. It's not an easy, it's not as easy as just saying the risk on the calendar is the initial debit. Okay. You can click on confirm and send if you want. It doesn't tell you. Okay. Take it back. That's the risk. So use the Analyze tab, and then you can go to risk profile and you can look right here on that. Okay. And you can just kind of see about 255. But keep in mind, when we talk about max profit, Max profit is right here, this little itty bitty point. We're probably not going to hit that itty bitty point there. Whereas max loss, of course, we're probably not going to go all the way out here, but it kind of plateaus, it's kind of a limit out there almost. You got that max loss that side and that side. Okay. So anyway, max gain, max loss, you can see it kind of flattens out there, max loss. So on this trade, on any trade, keep in mind that you should know going into it what your max gain is, what your max loss is, and what your probabilities are. That's the key. And if you want, you can do more than one contract. Just realize, since this isn't telling you what the max profit, max loss is, realize it by looking here and saying, well, 2 contracts, I'm going to double that. So it's going to be like $1.68 on that. All right. And so I'm going to send it. And there we go. Okay. Now, so there's some new trades for today. Those are all earnings. Those are all earnings calendars. So kind of a special use case, so to speak, on calendars. Now, one last thing I want to do here. Last week, we did a trade on CRM. Okay, that is right here. So here, this was kind of our more traditional calendar spread on this. I just want to talk about management of this. For the most part on calendars, they tend to be slower moving trades. Of course, unless we compress the time down to what we are doing with this earnings trade. But if we're doing it where we're buying out closer to 30 days, now a week has passed, so we're not at 30 days anymore, or closer to 2 months, it's going to be a slow moving trade. That can be very frustrating if it's doing what you want it to do. It can be kind of a relief if it's going against you and you see that your losses aren't piling up very quickly. But in terms of managing these, typically what we're going to be doing is we're going to be focusing on the front month, the sold call or put, if that's what you're looking at there. And of course, if we get to about a week till expiration, we'll look to get out. Okay? That's one reason we're going to get out. We're not going to hold this all to expiration. Remember, short options can be assigned anytime to expiration, regardless of the in-the-money amount, although the odds of getting assigned on something that is out of the money is significantly diminished, put it that way. But so that's going to be one thing. We're just going to get out. That's our time exit. In terms of things going well for us, well, if we've made most of what we can make on this contract, well, look, on this one, we sold it for $5.35. Right now, it's $3.15. We've made some money on this because we sold it up front. We would buy it back for less. If this gets to like where we've made 80% on that, we're probably going to get out on that. We'll probably roll it or just close it. You can close the whole thing, but that'd be a gain if we have gained 80% on that. Now, that's a good scenario. Okay, this is probably a pretty good scenario if we're going to the week. What about if it's like going totally against us? Well, here's what I would say is this. Right now, remember where your target is. My target on the trade is 190 on this. We want the stock to go to 190. And if we come to the conclusion that, hey, this is just not going to 190, let's say we think this is just going to go down and down and down, it's going to start trending down, we're probably just going to cut our losses on this or get out with what we can. Let's look at CRM. Here's CRM. And look, we got in on this thing it was about here, okay? our target is kind of here. It's actually dropped a little bit. So it's maybe a little bit surprising that we're showing a profit right now. If you are just if you just are bearish on this, then we just get out and take our profit. I'm not convinced we're just going to stay bearish on this. We did have the little gap down. So I'm going to let this, and I like to keep it going for just trade purposes. So I'm not going to take, for example purposes, so I'm not going to get out of this. But what I will do is we will reevaluate it probably on Wednesday in a Managing Your Options Portfolio webcast. Okay, so that is, so in this case, we're not going to do anything with it. We're going to let it cook, so to speak. We're going to let the time decay help us out. And we do have a little time decay. Remember, this is a positive theta trade. Theta, here's our total time decay on this CRM position. About $3.50 a day, everything else being equal to our benefit in terms of time decay. We also did a trade on Alphabet. You can see a much higher, let's see, here's a theta column. You know what? Instead of me scrolling up and down, you can pin the columns. You see this little anchor up here? Are you guys aware of that? If you click on the anchor right there, then when you scroll, look what happens. Oh, my theta column header is still there. Vega is still there. So I can scroll down and look at them this way. And I can see my theta, 42 bucks a day. Now, we're getting pretty close to expiration on this. So this is our earnings play. We did Starbucks as well. Starbucks, $29 a day in terms of the time decay. Doesn't mean the overall trade's going to go your favor, $29 a day, because there's delta impacts, there's Vega impacts, but just in terms of the time decay, there you go. You can double check that. All right? Okay. Now, in conclusion, let me just mention a few things. If you are interested in our webcasts, okay, what you can do is, one, you can go to schwab.com/coaching, if I can spell coaching, and it's going to come up to this page here. And then you can go and you can click on, in-person events, on-demand webcasts, live webcasts, and whatnot. Then you click on live webcasts, and it's going to come up with this. Here's our upcoming webcasts, okay? And this was this morning, so this is today's. But what you can do is, of course, you can go out and you can look in the future too. Here's Monday, Trader Talks, Straddles and Strangles, and so on. There's Mr. James Boyd, Trading with Technical Indicators. It's Monday, 1 o'clock Eastern time. So you can do that. You can also sort by the coaches you want. Go here and find your coach and do that. The topics, the skill level, all that good stuff there. So that's certainly a one way to do it there. The other thing is this, and I'm going to conclude with this. If you go to YouTube and just go to search on YouTube and go to Trader Talks Schwab. Now, you may be on YouTube right now looking at us. That's certainly likely. But you scroll down and you can see info for Trader Talks Schwab there. And in theory, there's also this right here. This is the channel right there. If you click on the channel, then you can go here and you can subscribe. All right, everybody. That's it. Coming up next, we've got market and sector analysis. Mike Fairborn teaches that class. It's a wonderful class. I encourage you to check that out. Encourage you to subscribe to Trader Talks. I encourage you to, if you like the webcast, click on the little thumbs up, the like button at the bottom. We appreciate it when you do that. It benefits me. It benefits our cause of free education in terms of promoting our webcasts. Thank you for taking some time out of your day to be with us. And let's see. That's it, everybody. Have a great weekend. Bye-bye.